Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us by phone, we have Shawn Cruz. He's the manager of trader services over at TD Ameritrade with a midday update. And Shawn, what a day it's been. We've seen historical moves just about every day over the 6 trading sessions.
Yeah, and I think the thing here is that it hasn't been enough for the Fed just come out there and cut rates. I think a lot of investors and analysts wanted to see the Fed really expand their balance sheet and do even more than interest rate cuts. We did get that announcement today that they're going to move back into the commercial paper market, similar to what they did during the financial crisis. I think it is worth pointing out that the Fed has actually been expanding their balance sheet. Going back to last August, it sort of bottomed out, hit a little bit of a trough, and it's been climbing ever since. Tomorrow, we'll actually get another look at their balance sheet, and I expect to see an even steeper increase in the size of their balance sheet, given everything that they've announced, everything that they've already done over the past couple of weeks to try and get out there and sort of keep financial conditions loose.
All right, let's take a look at our first chart here, and this exemplifies what you're talking about with the balance sheet, and we can see it kind of hold steady for a bit, and then there's certainly more movement towards the right of the chart.
Yeah, and that's really where the Fed started to step out there and cut rates and just engage in other activities that start helping out. You know, there's repo markets. They've, like we said, they announced they're going to get into money markets. But seeing the Fed expand that balance sheet, what that means is that the Fed is actually going out there and making these purchases, which should help shore up any sort of liquidity issues or fears that market participants were starting to have. And the announcement today that they are going to start intervening in the commercial paper market should only sort of amplify that effect on their balance sheet. So definitely something to watch moving forward. But I think that is what a lot of investors and traders wanted to see, was the Fed really step up their presence in the asset markets.
All right, and another important thing we've been watching, we can see this on our second chart here, of course, yields has been a big part of this conversation, in addition to what we're seeing in the equity markets.
And there's really two things that we're looking at for what can drive yield lower. If you're looking at the 10-year, which at one point got just incredibly low, down to about 0.3%. It has moved higher recently, but I think it is worth pointing out that right now what has really been behind such a complete drop-off in that 10-year yield was the thought that this demand shock we're expected to experience, and I think it's generally agreed upon by economists across the board, this is going to lead to a significant slowdown, if not outright recession, is also going to be deflationary. And so we can try and take a look at what is being priced in terms of inflation expectations into a lot of these fixed income and interest rate markets by looking at the 5-year forward inflation measure. And if you just take a look at the chart of that, you see it really just went off a complete cliff over the past couple of weeks. So it makes sense that you're seeing that plunge in interest rates, and it really shows that there's expected to be little to no inflation here moving forward.
All right, let's move along to our third chart here. And this is a heat map where we can see what stocks are really trading in the green and which ones are having some negative pressure today. And if we take a look all the way to the bottom right, where consumer discretionary is, if you take out Amazon, you see all those retailers, those brick and mortar stores are really feeling the pressure with consumers not being able to go to work.
Yeah, and Amazon is sort of the outlier here. And one, they have Amazon Web Services, which sort of it can act as a cushion right now to the retail business. But even the retail business itself, they're probably just getting an absolute influx of orders right now as everyone's staying home, and they're trying to get all those supplies, anything they need delivered. And it doesn't matter if you need a loaf of bread or a new computer, you can get all of that on Amazon. So I think that's another reason why Amazon's staying out here a little bit. And they did announce today that they're going to come out and they're going to hire another 100,000 full-time and part-time workers. So it shows solid demand for their business, and they're actually having to go out there and hire when everyone else is looking at actually cutting labor forces. They're seeing such strong demand that they're adding more employees. But if you separate that out and look at what we're seeing from a lot of these other retailers, the same phenomena that's driving people to shop on Amazon is actually really going to hurt some of these retailers moving forward, as there's just no foot traffic, anyone of any sort going in their stores. And some people may even be delaying some of those purchases and focusing instead on maybe a lot more of those more staple type items, which is also not going to benefit some of these retailers as well. But just generally speaking, if you rely on people coming in and out of your stores, and it doesn't matter if you are Macy's or if you're McDonald's, this is really expected to be a pretty turbulent and difficult patch that a lot of these retailers are going to have to write out here moving forward. And that's really a big spot of weakness we're seeing in markets today.
All right, and we can actually see these in the numbers. If you take a look at our fourth chart here, Kohl's and Macy's, it's really starting to hit the bottom line.
It is, and that's where the real concern here is. And we had Citigroup come out and they cut some price targets across the board. Macy's effectively got halved, going from a $13 price target to a $6 price target. But they're not the only ones that are going to be in trouble here. And what the concern is if you really stop getting those revenues coming in the front door, you can start running into cash flow issues, and your ability to make some of those payments that you are obligated to make, be it a debt payment, a lease payment, anything. That is something that a lot of analysts are starting to focus in on. And in companies that don't have the ability to make those payments, or they're seen as barely getting by just where things are right now, they're expecting those companies to hit serious distress here in the coming months. So you're seeing that one priced in these companies that have very low fixed charge coverage ratios, which is their ability to cover those fixed payments. Can you generate enough cash to do that once a month, twice a month? You want to see them be able to do that many times over. You look at Macy's and Kohl's, certainly at the bottom end of that. And if you want to see where that's being priced in, if you just look at cash flow, not earnings, just cash flow itself that the business is kicking off, which is what you use to service those payments, price to cash flow ratios show that Macy's and Kohl's also is at the bottom end of that. So there is really not a lot of optimism about Macy's and Kohl's relative to their peers to be able to manage some of this moving forward.
All right, in our fifth and final chart, we can really see that here because retail has always been a tale of the have and the have-nots, and the big box retailers like the Walmarts, like the Targets, that have really fixed their omni-channel presence and really invested in online retailing. They were outperforming even before we all knew what coronavirus is. I mean, Macy's was talking about a 3-year restructuring plan even before we started talking about the global impact of the virus, and that divergence, it seems as if that would have continued regardless if there was a shopper shutdown or not.
I agree. And if you look at what you're seeing here, and I just started towards January when you started to see the first cases really start making a meaningful appearance here in the West. That's when there really was this concern, okay, which retailers, and we're going to see people maybe step back, be a little bit more fearful to go out there and shop. Which retailers are really going to get hurt the most, and which retailers maybe have some of those goods that everyone is going to want, everyone's going to need, and also has the ability to deliver that experience not only in store but also online. So the companies that have really not only are offering those goods, that's going to give you a little bit of a premium or a better performance. But then also the companies that have the online piece figured out much more. Even if you have that box of Clorox wipes that everyone wants, if they have to go to your store and do it versus going to someone else and just having it delivered, they're going to take the delivery every time. So those companies that have that online presence figured out and can deliver on those staple type items, those are the retailers that are hanging in a little bit better here, and the ones that are really on a much more the discretionary side and really rely on getting a lot of traffic through their stores. Those are the ones that are really getting hit hard here. And then also you can see here, once again, these highly levered companies, Macy's and Kohl's, having sort of the worst performance here, as distress certainly is something at the forefront of concerns for a lot of investors and analysts.
All right, my friend, thank you so much for joining us. As always appreciate the insight. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.